Welcome to the Deep Dive. We are Talk Tickers. Today, we're jumping straight into the Union Pacific Q3 2025 earnings call. It just wrapped up this morning, pre-market.
Yep, and our goal here is pretty simple. Cut through the noise, grab the key numbers, understand the strategy, especially around that huge merger they're attempting, and maybe most importantly, figure out the market reaction. Because UNP actually delivered a solid operational beat, but the stock didn't seem to care much initially.
Yeah, that's the puzzle, isn't it? Why ignore good execution? Let's start with that snapshot. Operationally, like you said, pretty stellar. Adjusted EPS, that came in at $3.08.
Right, and consensus was looking for $2.99. So nice 9-cent beat there. JAP was $3.01 for context.
Okay, and revenue?
Revenue landed at $6.24 billion. That was pretty much right on expectations, up about 3% compared to last year. But, for rails, the big one is always the operating ratio, the OR.
Always. Lower is better, right?
Yeah.
Expenses as a slice of revenue.
So what do they post?
Adjusted OR was 58.5%.
58.5. Wow. And how does that compare? That's the impressive part. It's a 180 basis point improvement year over year.
Yeah.
A really significant step down. Management was definitely highlighting that, saying it shows they're serious about gunning for an industry-leading OR.
Okay, let's pause on that 58.5%. 180 basis points is a big move. Where does that actually put them competitively? Is that best in class now?
Not quite absolute best yet, but they are closing the gap incredibly fast. It signals, world-class efficiency is within reach. It's proof of really disciplined operations, not just like a lucky quarter. And it definitely puts pressure on their rivals. Think CSX, BNSF.
Right, so a masterclass in margin improvement, basically. But then the stock dropped more than 2% in early trading.
Exactly. And that disconnect tells you everything. It says investors right now are looking past the operational wins. They're focused squarely on, something else. External factors.
It feels like the market sees UNP primarily as a regulatory story at the moment, not just an operational one. But we can't skip over just how good these Q3 operations were. You called it a textbook rail beat.
Well, management called it that, but yeah, the data backs it up. Look at freight revenue if you strip out the fuel surcharge, up 4% year over year. They said that was a best ever quarterly record.
And driven by core pricing gains, which is key. It means customers are paying more, presumably because the service is better, more reliable.
And you see that service improvement directly in the efficiency metrics. They didn't just improve, they set multiple quarterly records. This wasn't a fluke. Car velocity, how fast the trains move, hit 226 miles per day. That's up 8%.
Think about that from a customer perspective. Faster transit times mean less inventory tied up. That's real money for them.
Totally. And maybe even more important, terminal dwell time. How long cars sit around waiting. That dropped 9% to 20.4 hours. That is a huge improvement in fluidity.
Less time sitting idle means your network capacity effectively goes up, right? Without laying any new track.
Absolutely. Faster velocity, lower dwell time. That creates a much more reliable, predictable service. And that operational excellence is what allows them to command those core pricing gains we mentioned. Plus, workforce productivity was up 6%.
Okay, but let's push back a bit here. The cost side. It's effective financially, yes, but it involves cuts. They mentioned a 4% reduction in workforce levels. That offset wage inflation. And the fuel consumption rate hit a record low, too.
They are running incredibly lean, no doubt about it. It's great for the OR, maximizing those PSR, precision scheduled railroading principles.
But isn't there always a risk when you cut headcount that deep, especially when you're also promising top-tier service? That 4% reduction, can that level sustain the record service reliability if demand surges or, bad weather hits? Is that sustainable?
It's a fair question.
Yeah.
Management's implicit answer is, look at the record service metrics we just achieved with this workforce level. They'd argue they've optimized staffing for current conditions using technology and better scheduling. But you're right to flag it. It's the constant balancing act for any railroad running lean.
Okay, so strong core execution, but let's look at the different business segments, because that's where you see some of the headwinds emerging. Bulk markets seemed okay.
Yeah, bulk was actually a source of strength. Coal was surprisingly strong. Apparently, natural gas prices made coal more competitive for power plants. And grains got a boost from export wheat shipments, which helped offset some weaker domestic demand. Industrial was decent too. Petrochemicals, construction, metals showed growth.
But, and this is a big but, I think, the premium markets got hammered. International, intermodal, those container coming off ships volume dropped 17% year over year. 17%.
That's the number that jumps off the page, isn't it? A 17% decline. Ouch. Mostly blamed on lower West Coast imports. And look, that kind of drop isn't just a UNP issue. It raises questions about the broader economy, consumer spending, global trade flows.
Exactly. A 17% drop feels like more than just a tough quarter. It feels like a signal. And management seems to agree it's going to stick around for a bit. They said Q4 volumes, as of now, are tracking down 6% overall, partly tough comparisons, partly that ongoing intermodal weakness.
So you have this strange picture. Fantastic Q3 operational control, masking a really challenging volume outlook heading into year-end. Add in the merger costs, they spent $41 million just this quarter getting ready for the deal, and that's going to continue. You can see why investors might hesitate even with that great OR.
Makes sense. On the balance sheet side, though, they're clearly prepping for the merger. Paid down $1 billion in long-term debt, got the debt-to-EBITDA ratio down to a pretty healthy 2.6 times.
And confirmed, importantly, that the share buyback program is still paused. They're conserving cash, cleaning up the books ahead of the potential NSC acquisition.
Yet, despite the volume headwinds and the paused buybacks, they stuck to their long-term guidance. High single to low double-digit EPS growth over multiple years.
Which tells you their confidence is really pinned on the strategic story, the thing overshadowing everything else right now.
Right. Let's talk about the 800-pound gorilla, the proposed $85 billion merger with Norfolk Southern, creating the first true U.S. transcontinental railroad.
This is absolutely the central narrative. Everything UMP is doing, operationally, financially, it all seems geared towards convincing regulators this deal makes sense. And the strategic logic is compelling. A combined network, they argue, offers better competition against trucks and also against the Canadian rails.
And they're putting numbers on it, too, projecting, 15-20% faster transit times for merchandise traffic?
Yeah, mainly by eliminating interchanges. Those points where freight has to switch between railroads, often causing delays. A single-line haul avoids that. That's a potentially massive service improvement.
What really stood out to me was the stakeholder support they seem to have lined up already. Over 400 customer letters of support.
That's huge. Getting that many shippers on board before you even formally file is, well, it's pretty unusual and speaks volumes about the perceived benefits.
And maybe even more critical, labor seems aligned. Agreements concluded with all unions for this round, including a formal okay from the SMART TD union.
Labor piece is just essential when you go before the Surface Transportation Board, the STB.
And things are moving quickly. They're targeting the STB application filing for late November, maybe early December. Shareholder vote scheduled for November 14th.
Yeah, they are executing the merger process with real precision. TikTok.
But it's not all smooth sailing. The pushback is real. They mentioned rival opposition, specifically called out Burlington Northern, and concerns from groups like the Chemical Association. So if this merger is so great for competition, why are the rivals fighting it so hard?
Well, that's exactly management's point. They're kind of flipping the script. They argue the fierce opposition proves the merger will be disruptive and enhance competition. By creating a superior, faster, single-line service, they essentially force competitors to up their game or risk losing business, particularly to trucking. The pushback validates the strategic threat, in their view.
Interesting angle. So let's tie it all together. We have truly excellent Q3 operations, strong financials, a potentially transformative merger moving forward with impressive stakeholder backing. And yet, the stock initially sold off. What's the absolute bottom line here for someone listening?
I think it's crystal clear. Investors are completely focused on regulatory risk right now. The operational upside, however good, is secondary. That record OR, the great service metrics, they're seen as necessary table stakes to even have a chance at getting the merger approved by the STB.
So the market needs clarity on the STB's timeline, the conditions, the likelihood of approval before it gives UNP credit for the operational strengths.
Exactly. Until that regulatory fog lifts, the stock is basically trading as a proxy for the merger outcome. Yes or no?
Which actually creates a potentially interesting setup, doesn't it?
It really does. And that brings us nicely to our This Is Not Financial Advices segment. Remember, purely educational, hypothetical, like a brainstorm memo.
Okay, lay it out. What's the setup? We see UNP stock has lagged the transport sector recently, down about 4.4% over 3 months, while the ETF, IYT, was basically flat, despite the records we just talked about.
Right. Great cash flow, record efficiency, but merger uncertainty is weighing it down relative to peers. So the thesis is designed to isolate that UNP-specific factor. You long UNP stock. Simultaneously, you short a basket of its peers, or maybe just short the IYT ETF itself.
Okay, so a pairs trade. Long UNP, short the sector, hedging out the broad market or economic risk for transportation. What's the rationale?
It hinges on the two potential outcomes for the merger. Scenario 1. STB approves the deal. In that case, UNP likely re-rates significantly higher almost immediately. You capture the synergy value, the strategic premium of creating that transcontinental giant. The stock could really take off.
Makes sense. The market price is in the future value. But what about the downside? What if the STB blocks the merger or imposes really tough conditions?
That's where the second part of the thesis comes in. If the merger fails, what's the first thing UNP management likely does?
They restart the share buyback program that's currently paused.
Exactly. They unleash the balance sheet for shareholder returns. So even with the disappointment of failed merger, you have a catalyst. You combine the buyback returning, plus the fact that the underlying business is running at record efficiency, that 58.5% RR we keep talking about, and has paid down debt.
So the argument is that even without the merger, the strong operations and the return of capital should allow UNP to close that recent performance gap versus its peers pretty quickly. The short hedge protects you from a general sector downturn, and you're betting on UNP-specific strengths playing out one way or the other.
Precisely. It isolates the bet on UNP-specific catalysts.
Yeah.
Either merger success or fundamental strengths plus capital return driving out performance relative to the hedge short position.
It's definitely a provocative way to think about the current situation. Okay, let's recap. UNP delivered a very strong operational quarter in Q3. Record efficiency, record service metrics, disciplined financials, clear long-term goals.
But the market's gaze is fixed firmly on the $85 billion NSC merger drama and maybe that worrying 17% drop in international intermodal volumes.
So the final thought we want to leave you with is this. Consider whether the market is currently underappreciating the foundational strength of Union Pacific's operations. Is the intense focus on the short-term regulatory battle for the merger completely overshadowing the value of a company hitting record efficiency before any potential synergies are even realized? What's their underlying quality worth?